I want to talk about the market action last week because there were some signs that some underlying conditions in the market. Now there are some opportunities developing as well, so I want to talk about that. I want to take a look at the sector performance last week, what was winning and what wasn't, and what that might mean for the future coming up as well. So let's start by taking a look at the S&P 500, the price action last week. If we take a look here, we can see on Monday we saw the S&P 500 was up. Tuesday the S&P 500 was up higher again. Now really the price action was coming into Wednesday because everybody's waiting for the CPI report to come out as being the big mover for the week, and it came out. We saw the CPI report come in, and we saw the CPI come in at 2.4% on a year-over-year basis, which was lower than expected. It was expected to be 2.5%. This was good news. In fact, in general, the inflation numbers were better than expected, and yet the S&P 500 moved lower for the day. So that's not a good sign when you see the stock market react negatively to good news. And then on Thursday, we did see some corrective action. We saw the S&P 500 up higher. Now that was despite the continuing jobless claims that came in higher than expected, which is not good news. But the really key one, I think, was the CPI on Wednesday, indicating the overall sentiment for the market. And then on Thursday night, we saw Israel launch an attack against Iran. I'm not going to get into the war back and forth, but we saw the stock market head down on Friday. Now, what's interesting is, given the scope of this potential conflict, the S&P 500 really didn't move down that much. And perhaps it's because the market thought that Israel had dealt a bigger blow than expected and really hampered Iran's response capabilities, but we did see Iran, counteract to that as well. Which I'm not going to get into it, but all I want to say is that the S&P 500 really didn't move down a lot, given the gravity of the situation as well. Which we're seeing a lot of that interpretation of events in the market being, oh, it's not that big of a deal. We can handle this, and the S&P 500 is going to move higher. So with some really positive sentiment taking place, despite what we saw on Wednesday last week with the market going down with a better than expected CPI. I just wanted to show the trip for the S&P 500 since February the 19th, which was the high for the S&P 500. We're going to go back and measure it back to 1969 in comparison to drawdowns of 10% or greater. You can see here that this shaded area here represents the 20th percentile to 80th percentile of those drawdowns and recoveries. And you can see that this is in April here. It was a bigger drawdown than the typical. And what we've seen here is it was also a much bigger recovery than typical as well. So a bigger drawdown and a bigger recovery as well. It's an interesting fact. It doesn't mean that much, but we have seen the S&P 500 move higher very quickly. And if you take a look at this point, usually this black line is the median. You tend to see a little bit of flattening out here. Of course, we can see it move higher from here, but given the scope of how much we've moved, it wouldn't be surprising to see it start to level off, at least on the upside. However, if we do take a look at the weekly chart for the S&P 500, it has been forming this wedge pattern taking place here with some lower bottoms here. And you can see here that the wedge typically is a consolidation pattern. And when it breaks out to one side, it typically means it has a tendency to go lower. Not all the time, just an increased probability of that taking place. And on a weekly pattern, we did see the S&P 500 actually move lower and out of that wedge last week. Last week, overall, the S&P 500 was just down 0.4%. The big winner of the week, of course, was the energy sector. Really, that was a big response on Friday with oil moving up over $10 a barrel. So the energy sector was positive. We don't really get a lot of indications from the other sectors of the market, which way the market's going. Is it becoming more defensive or cyclical? We did see healthcare actually do okay. Utilities was positive. But if we take a look at the growth sectors, we didn't see some big moves either. So we don't get a lot of read out of this right now as far as the conditions based upon sector performance, other than which was the energy sector, which was a little bit out of the ordinary here. And if we take a look, the TSX actually was up 0.3%. TSX 60, and this would be expected under the conditions with oil up so much, as well as gold actually performed well last week. Here's a look at some of the subsectors. Here's gold up. Gold miners up 5.5%, absolute tear this year, and gold itself up over 3%, up 3.7% last week. Here's the yield on the U.S. Treasury note. Now, it did close down slightly last week. But if we take a look here, here's April, the bottom that took place. We saw that rapid move up that really scared a lot of investors as we saw money move out. And the U.S. Treasury, the 10-year yield increased. But really from there, we're actually lower at that from this point. So we have seen some stability starting to take place for the 10-year yield, which is a good thing. However, if we look at the US dollar relative to world currencies, we can see that last week it did head lower, and this has been the overall trend really since earlier this year. Really has the US dollar has headed down quite a bit. Now, in a previous video quite a while ago, I actually showed the US dollar relative to world currencies when Trump got elected in 2016. We saw that pattern similar to now what was taking place. Before the election, the US dollar moved higher, and after the election, for a while, it moved up higher. And then we saw this multi-year heading lower for the US dollar. Trump wants a lower US dollar, and we're seeing a lot of things take place where we're seeing a lot of money being pulled out of the US, which is forcing that US dollar lower as well. So if we do follow that trend we saw in the first election, we could see this multi-year trend lower. If we zoom out on the US dollar, and here we are using the Dixie for the US dollar here, you can take a look here. This level of 100 is a really key level. It was a key level of support here, here as well. We saw that break, we saw it get retested, and then we saw that break once again, and here we are trading around just over 97. So the US dollar has broken, and this is below 100, which is a key support level. Now is resistance. This is not a good sign for the US dollar, so we could see some further weakness. And it's interesting that last week, despite the geopolitical tensions being raised in the Middle East substantially, we saw it wasn't the US dollar that benefited because it went down relative to world currencies. It was gold. There was a lot of money flowing into gold last week. This graph, this is from the Financial Times, but it was actually published numerous other places last week. It really caused quite a bit of a stir for gold in a positive way, because what we saw was, if we take a look at the US dollar here in blue and gold in light blue, the US dollar is the number one reserve asset for central banks, as would be expected. But we've seen gold actually really been increasing, and not just recently. It's actually been on the climb for quite a few years. But last week, it became the second most held asset by central banks. So what we might be seeing at this point is some investors who haven't been invested in gold going, well, if it really is that important to central banks, well, maybe we should be investing in it. And we saw perhaps a little bit of spike in gold last week because of this phenomenon. This graph shows a better relationship between the US dollar as a reserve asset and gold as well. And you can see here that the US dollar is the red here, US dollar here, and the gold is the gold. And so what we've seen is, if you take a look at the length of these red bars, we can see that they've actually been getting shorter, okay, all the way here, over the last few years. So the ratio of US dollars and gold relative to other currencies in the world really hasn't changed that much, but the US dollar has been going down. At the same time, gold has been increasing. So we're seeing this direct switch from US dollar to gold as an asset for central banks. This is quite telling. Now, I'm talking a lot about gold today because we are starting the strong seasonal period for gold very shortly. If we take a look at gold here on a yearly basis, here's that consolidation wedge that I was talking about as well. And we can see here that we've seen some moves here, but we can see here that gold so far this year to date, relative to previous years, has broken above that consolidation wedge. Now, we haven't finished the year, obviously, but this is a positive development for gold as well. It's not just gold. Silver, which starts a strong seasonal period as well in July, has actually, well, closed its highest weekly close since September 2011. So we're seeing silver actually do quite well here. Last week, silver did underperform gold, but in previous weeks, we've seen silver really picking up the pace. So a quick little plug for some of the short videos I've done. So these like a minute and a half, really. I did some videos on silver moving higher and talked a little bit about that. And I talked about the gold to silver ratio. Now, and historically, since 1985, we've seen the gold to silver ratio trade around 60. So in other words, gold has been 60 times more expensive than silver. Historically, it's been lower. But recently we've seen that ratio get stretched out to 100. So gold was 100 times more expensive than silver. And a lot of people follow this indicator, and since then we've seen silver picking up the pace. Anyhow, the video, I'm going to try and link some of these videos in the comments below if you're interested. They're short, they're typically around 1.5 minutes. And I also talk about gold as well, moving higher and some of the trends, and I talk about central banks driving gold. Once again, 1.5 minutes, I'll try and link the videos down below. So what should we expect in the markets this week coming up? Well, there's going to be a couple key drivers, first of all, for this week. We saw the Israeli-Iran conflict cause some damage in the markets, but not a lot last week. We're going to have to see if the market really starts to think that this might develop into a much bigger situation, which is possible because so far we haven't seen Iran or Israel substantially attack the Iranian oil assets. And if that does happen, it's probable that Iran would try and close the Strait of Hormuz, and 20% of the world's oil does move through that strait, so that could have a substantial impact on the price of oil. So that hasn't happened yet. That could be a development factor. It's very difficult to say how this war could develop further and have an impact, but it's going to probably have an impact this week one way or the other. As well, if we take a look at what possibly could be happening as another driver, we've got the Federal Reserve coming out with its interest rate decision on Wednesday. If we take a look at what's expected in this interest rate decision, here we can see, according to the CME FedWatch tool, this meeting coming up this week on the 18th, that 97% of the probability, according to the markets, that the Federal Reserve will hold its key rate at between 4.25 and 4.50 on the upper bound. So, in other words, they're expecting the Federal Reserve to do nothing. So, largely expected. So, it would be very unusual with such a high probability from the markets expecting the Federal Reserve to do nothing for the Federal Reserve to all of a sudden cut. They would only do that in a real emergency situation. So the expectations probably will hold substantially. But what investors will be taking a look at is the Federal Reserve starting to back off on its position? Because they're starting to open the door towards cutting, but with more language. Now, they really have been focusing on the hard data, like unemployment. Hard data remains really low, really well contained as far as employment situation is 4.2%. So, but the softer data around labor, most of it is showing some real weakening conditions. But they're really focused on that hard data. So we have to start to see if they start to mention some of the other soft data, and perhaps start to use language that they will respond as well. As far as the next meeting on July 30th, that expectation is once again that the Federal Reserve will do nothing, and not cut. And we have to go out to the meeting in September, on September the 17th, which is this graph here. And we can see here that now that threshold of the expectations of at least 50% that they'll cut take place. So the markets right now are not expecting the Federal Reserve to cut its key federal funds rate until September. I'm going to have to see if that starts to change after the Federal Reserve meeting goes, if that's going to start to shift towards July or not. And that really comes down to the rhetoric being imposed. But investors really shouldn't expect the Federal Reserve to cut this week. Another factor that I'm going to be watching this week is what's happening with the junk bonds and the credit spreads. If we take a look here, I'm just using the ETF junk, JNK. You can see here, since the bounce here in April, they've done really well. Junk bonds have done really well. So this has really been a risk-on move in the markets. They have started to become bought at this level here. But typically, we would like to see, if the market's going to go down, you typically see the junk bonds also start to sympathize with that. We haven't seen that taking place yet. If we take a look at the credit spreads here, the old standard used to be about 4%, but we did see it get down to 3% back, in COVID as well. And then we saw the credit spreads actually get really, really low in late 2024 and 2025. It was really quite remarkable. We saw that spike higher as well with the tariff threat, but we have seen it move back to just over 3%, which is still very low. but it's going to be interesting to see if we start to see credit spreads start to pick up, because we're actually below normal levels historically as well. But right now, this is saying the junk bonds and the credit spreads are saying that this market, is not about to fall apart. So I don't think we're going to see the market necessarily have a big, huge correction taking place here. It's going to be interesting to see what happens as far as that goes, because there's so many exogenous factors. At this point, I don't see the market signaling that the market's about to crash, and that can never be foretold necessarily, but we are seeing the market still on a risk on, but we are seeing the technicals for the S&P 500 starting to show some sort of rolling over here or weakness. So it would not be unexpected to see the market pull back here a little bit. Now, we on a technical basis, we do see, or seasonal basis, I should say, we do start to see the S&P 500 typically bottom in late June and rally into mid-July ahead of the earnings season. That tends to be a strong seasonal trend. Now, the S&P 500 has actually done well in its weak seasonal period, which has shown some strength here. And we'll have to see what happens. Now, the earnings last quarter, yes, they came out and they beat expectations, and everybody got excited about that. But you have to remember those expectations were lowered dramatically, like really, really a lot. So they created this really low bar to beat for earnings. And so we did see that beat take place. And we could see the same phenomenon take place as well, and the S&P 500 rally into mid-July like it has so often in the past. So we could see that take place. So perhaps there's an opportunity in the broad market still, maybe in a week and a half away from here. But it would not be surprising to see the market pull back into that period. On a seasonal basis for some of the sectors in the market, we start to see the biotech sector tends to perform well, starting later on in June. Gold and silver tends to start to perform well in early July. They've actually been performing well outside of their strong seasonal period, which is an indicator of strength as well. So we could see that continue on as well. And technically here we are close to all-time highs for gold, which is also a positive development as well. Bond yields are holding in right now. They really have their strong seasonal period. Their real sweet spot to the strong seasonal period really starts in July, later in July, and goes into September. But they can perform okay in this time period as well. So right now, I think we're probably going to see the market move a little bit sideways coming into the Federal Reserve meeting on Wednesday. A lot's going to depend on that meeting itself and the wording that comes out of that. And I think investors are going to change their tone a little bit on that. But the fact that we did see the market react negatively to the better than expected CPI report was not a good sign last week overall. So I do think the bias is towards the downside for the week and next week or two for the markets, perhaps leading into a good opportunity coming into that seasonal period that tends to occur of strength from late June into mid-July. It's going to be an interesting week. Thank you very much for joining me today.